Hello everyone, very happy to see you again for this new edition of Business Africa. Coming up in the show, Senegal wants to boost its electricity production through the construction of 2 new solar power plants. In Nigeria, the central bank is encouraging more loans, thus forcing banks to participate in the growth of the national economy. A flexible exchange rate regime, according to the Ivorian president, for ECO, the new West African currency that will keep its fixed parity with the euro. This is one of the most ambitious projects unveiled by Senegal, which announces the construction of 2 solar power plants by 2020. The country, which already produces more than 1,200 megawatts of electricity, aims to supply nearly 600,000 people with renewable energy. Details of Guy Rodrigue and Elaine Wangalwa. In Senegal, 2 new solar power plants will be built by the end of next year, thanks to funding launched by Scaling Solar, the World Bank's initiative that supports governments in financing solar projects. The 2 plants, located just over 100 kilometers from the capital in Kabone and Kayel, will have a generating capacity of 35 and 25 megawatts respectively. These plants will supply low-cost renewable electricity to about 600,000 people. A trio of international development lenders have made the funds available to project development partners, French power company Engie, and Meridium, a Parisian global investor and asset manager. The total investment cost for the projects amounts to 47.5 million euros, an equivalent of $53 million. Meanwhile, as at the end of last year, Senegal had around 134 megawatts of installed solar power generation capacity. The West African nation also has around 650 megawatts of total installed power generation capacity and is planning to deploy 200 megawatts of solar up to next year. President Macky Sall is keen to make Senegal a leader in renewables in Africa, with a 30% target for clean energy in the coming year. Banks will have to lend more for fear of being sanctioned by the Nigerian Central Bank. The institution that wants to revitalize the national economy has subjected banking organizations to a rate of risky loans, according to analysts, with the requirement of granting maximum credit to companies and individuals. Explanations by Erica Josia Market and Yasham Tizwa.
Nigeria's central bank will try to force deposit money banks, DMBs, to beef up their loan portfolio as part of a series of measures aimed at reviving an economy stuck with low growth. In a circular dated July 3, the bank said lenders who fall short of a target minimum loan-to-deposit ratio of 60% by September would have to maintain higher cash reserves equal to 50% of the lending shortfall. The bank is seeking to boost credit to businesses and consumers after a recent recession in Africa's biggest economy muted lending. Nigeria's economy has since recovered from the contraction, but lending has not returned as growth is slow and banks prefer to pack cash in risk-free government securities rather than lend to businesses and consumers. Several Nigerian banks had set ambitious expansion targets before an oil price collapse mid-2014. Some have decided to conserve their capital at the expense of higher profits through lending. The bad loan ratio has dropped to around 9% from double digits at the peak of the recession, but is still above a central bank target of 5%.
What will be the value of the ECO currency, which will replace the CFA Franc as announced by the Ivorian president in 2020? And what is the future of West African countries? These are the questions in which our guest will shed light in the second part of the program. I'll see you in a few minutes.